Have you ever seen a company that is making lots of sales, huge sales, but still having problem with cash? Or have you seen a company that is making a lot of sales but has profitability issues? Now, the answer to that problem usually lies in turnover ratios. So in this class, I want us to have a rock solid knowledge of turnover ratios. Turnover ratios are key element of ratio analysis, which we use in analyzing financial statements. So at the end of this class, you should be able to define turnover ratios, to understand and explain them. You should be able to calculate them, know their formulae, and be able to calculate them. And you should be able to avoid the common mistakes that students make regarding the calculation and interpretation of turnover ratios. It is not enough to calculate turnover ratios. You should be able to interpret the results. So if you're ready, I am. My name is Echela Okwori. I'm your accounting and finance coach. Let's go there. Now, we're going to begin with what turnover ratios mean. Turnover ratios are ratios that we use in analyzing how efficiently, how speedily, how efficiently a company uses its assets, that is inventory, PPE, basically its asset to generate sales. How are you using it to make sales? This is what we look at. Are you using it to make cash? Okay? So you have assets, but are you using them efficiently? This is usually what we calculate. So in this class, we're going to look at inventory turnover. We're going to look at receivables turnover. We're going to look at payables turnover. And we're also going to look at total asset turnover. Now, the first approach is for you to know the formula. When you know the formula, then you do the calculation. After the calculation, then you interpret the results. So if you are ready, let's go. We're going to begin with inventory turnover ratio. Okay, so let's look at inventory turnover ratio. Before we look at an example of inventory turnover ratio, let me share a story with you. Someone I know has a warehouse full of goods, that the goods have been there for so long to the point that the goods know the security man by name.
God have mercy.
So that's not inventory. That is museum stock. Okay, so now the first approach is to get the formula as I told you. So when you want to calculate inventory turnover ratio, the formula is simple. You get your cost of goods and you divide it by the average inventory. Where do you get the cost of goods from? Cost of goods sold, if you want, or cost of sales, as we call it. The cost of sales or cost of goods sold, they mean the same thing. So you get it from the income statement. So you go to the top of the income statement, that's the statement of profit or loss and other comprehensive income. If you go to that statement, you usually have the revenue at the top. You have less cost of sales. So you get your cost of sales figure from there. So after getting the cost of sales, the next thing you need to do is to get your average inventory. Now, average inventory is simply the opening inventory plus the closing inventory divided by 2. You take the average. Where do you get the opening inventory from? Usually you will see opening inventory, okay, in the question given to you. If it's a real life situation, you know your opening inventory, your opening stock. You know where to get it. If it's an exam, you will get the opening inventory in the trading account, where we say opening stock, add purchases, less closing stock and all that. You will get the opening inventory. The closing inventory is usually in the additional information. So once you get the opening inventory, you add the closing inventory and you take the average. So you divide it by 2. You will have what we call the average inventory. So when you say cost of sales divided by average inventory, it will give you your answer. Okay, so let's look at an example. A company has cost of sales, $12 million, opening inventory, is $2 million. Closing inventory is $4 million. Calculate the inventory turnover ratio. That is easy peasy. So you just need to slot in the formula, slot in the figures into the formula. And the formula is inventory turnover ratio is equal to cost of sales. So we already have the cost of sales to be 12 million. Okay. Now next you go and calculate your average inventory in your workings. The average inventory is the opening plus the closing divided by 2. The opening given to us is 2 million and the closing is 4 million. When you add that together, that will give us 6 million. You divide it by 2, it gives us $3 million. So when you apply the formula, you have $12 million divided by $3 million, which will give us 4. Now that 4 is the answer that is very significant. It means 4 times. The interpretation is that the company will sell and replace its inventory 4 times in a year. So it means the higher your answer, the better. A higher inventory management means a higher inventory turnover ratio means the company's inventory is fast moving. It means they are efficiently managing their inventory. But on the other hand, if it is a low ratio, it means the inventory is slow moving, and this can bring about obsolescence. So there's the risk of obsolescence where new technology will come, and once there's new technology, your inventory becomes obsolete because nobody wants to buy them again because they don't need to use them. So the higher the inventory turnover ratio, the better. So our answer is 4, and it means 4 times in a year. That is when they sell and replace their inventory. Okay, next we're going to look at the receivables turnover ratio. Now, this is also very easy to calculate and understand. Before we delve into it, let me share a story with you. I know someone who has so many customers. I mean, the business has so many customers. But guess what? The customers are full-time debtors. So you know what that means? It means they buy on credit and they don't pay. So your sales do not automatically translate into cash. You only have cash when your customers actually do pay for what they buy. Now, when we calculate receivables turnover ratio, it helps us to understand whether we are getting cash, whether we are generating cash from our sales, whether we are actually collecting on time. So we also call this debtors turnover ratio. It measures how efficiently we are collecting money from our debtors, people who buy on credit. So let's look at this exam question. Given a business report where our credit sales is equal to $18 million, opening receivables, we have $2 million, and we have closing receivables of $4 million. Calculate the receivables turnover ratio. So what is the formula for this? The formula is simple. It is credit sales divided by average receivables. So the formula is very easy to understand. Credit sales, where do you get your credit sales? In an exam situation, you will be told whether the sales are on credit or whether they are not. So you don't use cash sales when you are calculating receivables turnover ratio. You use only credit sales. This is because we are looking at our ability, the ability of the company to collect from debtors. So if you use cash sales, you are wrong. We're looking at debtors turnover ratio. That's another name for receivables turnover ratio. So you have to use credit sales. If you have cash sales, you cannot use them. You are not correct. It must be credit sales. And you are dividing credit sales by the average receivables, or the average debtors, if you want. So you will be given the opening receivables and you'll be given the closing receivables. If you're not given that, you have to deduce it from the question. So once you get that, you get the average. Opening plus closing divided by 2 will give you the average receivables. So you take your credit sales and then you divide it by the average receivables. This is what gives us the receivables turnover ratio. So if you have a high ratio, what does it mean? It means that you are collecting on time. If you have a low one, it means you're not collecting on time. So it means you have a problem of, you might have problem of liquidity in your company. So in this question, we have credit sales of $18 million, opening receivables of $2 million, closing receivables of $4 million. And we're asked to calculate the receivables turnover ratio. So slotting this into the formula, which is credit sales divided by average receivables, it gives us the average receivable is simply the opening plus the closing, which is 2 plus $4 million, which will give us 6 divided by 2 will give us 3 million, of course. Now, when you divide 18 million, which is the credit sales, divided by 3 million, you have 6 times. So the company collects its receivables 6 times per year. That's what it means. So this is a high ratio. If it is high, it means there's fast and efficient collection of debt. And if it is low, it means there's poor credit control and there's a risk of bad debt. Some people may not pay at the end of the day and the company will be forced to write off the bad debt. Okay. Next, I want us to look at payables turnover ratio. For payables turnover ratio, we are looking at credit purchases. Credit purchases. That is also called creditors turnover ratio. So here we are looking at how fast we pay. Okay. So the formula is simple. You take your credit purchases and you divide it by the average payables. So average payables is opening payables plus the closing payables. That is opening creditors plus closing creditors. You add them and you take the average. That means you divide by 2. So once you get your average payables, you take the credit purchases, you divide it by 8 and you have your answer. Now that answer, what is the interpretation? The interpretation is simple. If you have a very high turnover, that is payables turnover ratio, it means you are paying too fast. And if you are paying too fast, it is not good for the company. It means you have a problem of cash retention. I mean, if you have to pay your creditors every time, maybe you pay them every time, when do you have cash to run the business? So that becomes a problem. So for this category of turnover ratios, for this particular category, if you have a high ratio, it is not good. Rather, a low ratio is better. So when you have a low ratio, it means you have more cash in the organization, in the company to run your business. But if you have to pay very fast, it is not very good for the company. So let's look at an example very fast. We have a company having credit purchases of 9 million naira, $9 million, opening payables of $1 million, and closing of 2 million. So the first thing to do is to get the average of the payables, which is 3 million divided by 2, which will give us 1.5. And you have the credit purchases of 9 million. So 9 million divided by 1.5, that will give us 6 times. So 6 times, the interpretation, it means the company pays its suppliers 6 times in a year. So that may be high, that may not be high. It is relative. It depends on the business. It depends on the industry in which the company operates. But the guide is that a higher ratio means that the company is paying too fast. They are paying their suppliers too fast, too much. And once you do that, you have problem of liquidity. So a lower ratio means there's better cash retention. But a high ratio means you are paying your suppliers too quickly. Lastly, we look at that's the total assets turnover ratio. Imagine that you have a shop full of big machines. You have a company full of very big machines, but these machines are not used. You just use them to show on social media. Well, assets are not for decoration. Assets are supposed to be used to generate revenue. That is the essence of turnover ratios. Turnover ratios, as I said before, they show how efficiently, how speedily the assets of the company is being used to generate revenue. And these assets are usually your inventory, your trade receivables, and your PPE. So how are you using them to generate revenue, to make cash, to make sales? So for our total assets turnover ratio, the formula is simple. You get your revenue. Where do you get revenue from? Definitely from the income statement. So you go to the top of your income statement, you see your revenue, you get the revenue from there, and then you divide it by the total assets. Where do you get total assets from? Definitely from the balance sheet. That's the statement of financial position. So you go to your statement of financial position, the SFP, you will see current assets and you see non-current assets. You total it, you have the total assets. So you divide revenue by the total assets and it will give you a figure. And that figure is significant. So it means that for every amount of asset that you have, the asset generates so and so amount of revenue. So let's look at an example very quickly. A firm reports revenue of $25 million and total assets of $10 million. What do? You divide the revenue by the total assets, that is 25 million divided by 10 million, which will give us 2.5. Now this 2.5 times, what does it mean? It means that for every $1 of assets invested in the company, they are generating 2.5 in revenue. So this is very, very key. All right, if you enjoyed this class, I want you to like, I want you to share, and don't forget to subscribe to the Accounting and Finance Coach for more explanations on accounting and finance topics. Let's learn financial literacy to make our society a better place. Remember, in the exams, you are looking at credit sales. You are also looking at credit purchases. Don't mix it up. You are also taking the average. Where you have opening inventory, for instance, and there's no closing, it means you have to assume that the closing is 0. Take this as your homework. A company has cost of sales of $20 million. The average inventory is $5 million. What is the inventory turnover ratio? I want to see your answer in the comments.